I can't stress enough how deep this downturn in the condo market has been. In 2025, we had 1,600 new condos sell. It was the lowest volume of new condo sales since 1991. If you look at the supply trajectory in the coming years, it would suggest that there's upside for both condo prices and condo rents. Condo starts in 2025 have dropped 88%. If you look towards the end of this decade, we're not going to be delivering any new condos at all. And that's not a forecast, that's a reality.
Welcome to the Rent Report by Urbanation, a podcast where we break down the data shaping Canada's rental and real estate markets. In collaboration with rentals.ca, we go beyond the headlines to unpack the trends, decode the numbers, and explore what they mean across the country. Let's get started.
Hello and welcome to the first episode of the Rent Report by Urbanation. Today I'm here with Shaun Hildebrand, president of Urbanation, and Max Steinman, CEO of Rentsync. Shaun, Max, thanks for joining us.
Thank you. Great to be here.
Thanks for having us.
So I thought I'd start off with the company news, which is that Urbanation has been acquired by Rentsync. So would you guys mind explaining what was the impetus behind this acquisition and what do you think is next for the new partnership?
Yeah, it's really exciting news for us, we're thrilled to be combining forces. The way we look at it, Rentsync and through Rentsync, rentals.ca, and our subsidiary brands has access to the most rental data, in-market rental data across Canada. And with Urbanation, we've got the sort of premier data analytics and research firm in the real estate space in Canada. And so you can see how naturally combining the two, lots of data and lots of experts in data can make for potentially a really bright future where we can take, our data and analytics products across Canada, which is our goal.
Yeah, it's a great opportunity for both companies. I'm personally really excited about this. The rental market is an area of the housing market that traditionally hasn't had a lot of transparency from a data perspective. Obviously, there are some national organizations that report on the rental market, but there's not a lot of fine-grained analysis in data on all of the sort of micro movements across the market. And having access to mountains of rental information and rental data through this acquisition is it's incredibly important, not only for us as analysts that are trying to understand what's happening across the market, but for the industry and really the public at large for being made aware of changes in the market in real time. We have a greater percentage of the Canadian population that is renting today compared to what it was over the past number of years. More and more households are renting. We can see that in the data. We're seeing developers pivot from ownership housing into purpose-built rental for the first time in decades. And they're needing to make, very significant investments in that and require, the best possible data. So having access to this data and building out a platform together that is going to, inform the industry, inform the public around what's going on in the market truly on a micro level and on a high frequency level, I think is going to, it's going to transform our understanding of the rental marketplace.
Okay. Now, jumping right into the market, in Urbanation's Q4 rental market report, we saw that rents, of course, are down in the GTHA, which is in line with the national aggregate trend, arguably is even driving the aggregate national trend. But we also saw that rent per square foot is down in the GTHA, which is sort of the opposite of the national trend. We've seen rent per square foot continue to increase. So what do we think is unique about the GTHA market or the conditions of the market right now that we're seeing these price decreases across the board?
Well, one thing we can sort of step back and take a look at the national level is that the secondary rental market has been the segment of the market that's really been driving rent decreases. As there's been more condos that have come online that were pre-sold to investors who have had some difficulty, obviously offloading those units into a softer ownership market. They've been holding on to them in the rental market. That's added a lot of supply and it's contributed to decreases in rents. So in a market like Toronto, which is for the last few decades has primarily relied on condo investors for new supply, that's had an outsized impact. Last year, and actually over the last 2 years, we've had 60,000 condo completions in the GTHA. That's like a volume of new supply that you would normally see over the course of 5 years happening just in the past 2 years. And most of those units were sold to investors. Those investors, even though they're experiencing pretty steep negative cash flow, have continued to hold on to them in the rental market because there's a demand for them. They've been able to fill those units. Even at somewhat lower rents, there's still a market there to fill those units. Um, so as that supply has come online at the same time as we all know, population inflows have slowed down. The economy is softer. There's less growth in demand. More supply, not as strong demand has led to some decreases in rents. However, the decreases have been pretty moderate so far, I'd say, just given how quickly rents increased in 2022, 2023, when you saw double-digit rates of growth. The decrease that we've experienced over the last year to year and a half has actually been fairly mild in comparison. So when you look at rents today versus where they were, 5 years ago or even before COVID began, they're still higher. So I think we're going through a bit of a rebalancing in the market right now, where we're dealing with a temporary infusion of supply and some temporary changes in demand. The transition within the rental market, at least within Toronto and the GTA, has been pretty orderly overall, but definitely one of those rare moments where renters can kind of take advantage of improved affordability, because it's not often that we talk about improvements in housing affordability, particularly in Toronto. So my message has been to any renter that's out there looking for a unit, take advantage, because rents are down, and they normally don't do that. And the supply that we're seeing in the market today isn't going to last. So it's a renter's market for sure, but not something that we're expecting to see last for too much longer.
Yeah, I think one of the more startling stats that I saw in the condo market report was that 10% of the pre-sold units registered in 2025 failed to close, which I imagine a lot of those are being pushed onto the rental market on the secondary rental side.
Some of them are. So you have inventory that's coming from recently completed condos that was never pre-sold to begin with. So when you have a record volume of completions and a percentage of those have been left unsold, it's also going to push up standing inventory. But as you mentioned, on top of that, you have a certain percentage of condos that were pre-sold during the market peak that are now being delivered into a softer market, where the buyers are basically defaulting. Now, that could be because they can't arrange a mortgage, because perhaps the value of the unit has declined more than the amount of investment that's been put in terms of the deposit. But one way or another, developers are having to take back more of that inventory. What they're doing with that inventory is an interesting question. If they do rent it out, there are some HST implications, so it does trigger HST, and obviously that's an added cost, and so they have to be careful about kind of what their plans are and how they kind of strategize around what they do with those units. In other cases, they're looking to offload them in bulk deals. They're putting them on the resale market. It's a variety of different situations, but it's a new thing for developers. They haven't had to deal with completed and unsold inventory really ever, because all the units were pretty much sold at pre-construction or during the construction phase. So it's shifting what they do with these units onto kind of having to sell completed inventory to one where traditionally you'd have to sell them in the pre-sale market. So it's been an interesting transition for sure. But as this all has been happening, we've obviously seen more projects having to cancel, very few projects launching into the market. Developers are really kind of shifting their attention to dealing with, standing inventory than having to really start construction on anything new in this marketplace.
I think one of the interesting things going on, because it's a lot of the secondary rentals are coming to market, kind of in a flood through the condo investors. I was actually talking about this with a couple of clients in the last couple of weeks. The flood of supply may actually be having an outsized impact on driving prices down in comparison to other supply floods we've seen in the past, because it's in the secondary market and because it's with condos. Often what we're seeing right now, and even on rentals.ca, across our listing site network, we'll see a condo building with 10, 15 of the exact same unit layout, all within the same building, basically just floor 10, floor 11, floor 13, stacked on top of each other, same unit layout. And I think in economics, it's actually called like the Bertrand competition, where you've got this very near identical product that is almost entirely competing against itself on price. And it actually helps to drive price down even further than differentiated products. So the impact on rental prices, not that it's outsized, but it might just be larger than what we would see if a whole bunch of differentiated purpose-built rentals was coming to market at the same time, where sort of the inventory control is in the hands of, in terms of releasing and marketing units, is in the hands of one owner. Here, it's in the hands of hundreds of owners within a single condo, and I think that's helping to actually drive pricing quicker to perhaps like a floor level in each building.
Yeah, you have to kind of think about it like the individual condo investors, they just want to get the rent as quickly as possible. They want to get the unit occupied as fast as they can. So they'll drop the rent much faster than a professional landlord would that could be a bit more strategic about carrying some vacancy and maybe offering it some incentives and waiting a little bit longer to hit their rent. For an individual investor that has a mortgage and has condo fees and property taxes, they need that rental income as fast as possible. Each month that they carry vacancy is extremely difficult for them. And as you said, they're competing against hundreds, if not thousands, of other units that have kind of similar attributes, and it's a bit of a race to the bottom when you have all of this supply arriving at the same time. So it's kind of an unfortunate situation where you have all these condos kind of finishing construction all at the same time, and demand unfortunately is weak when they're being delivered. And it's kind of the issue overall with the way that we build, and that you can pre-sell to investors in one market and then deliver them in a very different market 5 years down the road. And it's been a bit of a leading indicator for the purpose-built rental market, particularly in a market like Toronto, where the majority of that supply comes from condo investors. So individual landlords and professional property managers within the purpose-built rental stock have to compete with those condo investors on rent. And what we've seen is that they have as well reduced asking rents. So for brand new and existing stock of purpose-built rentals, we've seen some deflation in rent, but it's been relatively mild, maybe down 1 or 2% year over year. But where we have seen the biggest change is in concessions. And if you actually do the math on those concessions, which are pretty material in this market, in fact, our research showed that about 70% of all purpose-built rental buildings were offering some form of incentive. And out of that, more than half were doing 2 months of free rent. When you start to back that out of the actual face rent, you're looking at a net adjustment of around 12%, which brings the purpose-built rents within newer stock pretty much in line with a condo investor. Um, so they're looking at that secondary supply as kind of a leading indicator of where their rents need to be, because in a market like Toronto, purpose-built rentals, in terms of new stock anyways, is still kind of a small area of the market relative to the sheer volume of condo investors that are out there. Like, you think about the fact that in Toronto, there's like 500,000 condos, and more than half of them are owned by investors that are renting them out. Like, they are the market setters when it comes to rents, and purpose-built rental operators, they kind of have to take that lead, particularly in a softer market where, like I said, those investors are all kind of competing against each other and dropping their rents pretty quickly.
So I think this is an interesting discussion about weakening demand in the same time as the supply surge. We've also seen, from Stats Canada, we know that net international migration has been declining rapidly. It's actually been negative for the last 2 quarters. But one interesting stat that I saw in the Q4 rental market report was that we saw record high rental absorptions, almost 5,000 units in 2025. So do we think that it's actually weakening demand that's going on, or is it just that demand is much slower than the new supply coming to market?
Yeah, it's an interesting dynamic. Like if you looked and saw the number of condos that are being leased out right now, it's at a record high. So for 2025 as a whole, there was 65,000 condos that were transacted uh, in the calendar year. It was a record high. It was up 15% from the previous record high, which was 2024. And it just goes to show you that the absorption is still there. So even though we're seeing a lot of supply come into the market, the units are being readily absorbed. Now, part of that is renters that are being opportunistic and switching units. So, uh, part of it is driven by changes in the economy. So, higher levels of unemployment, slower income growth. People will kind of look towards more affordable options. But in other cases, it's the rents have come down. I signed my lease a couple of years ago, and I can find a unit for $100 or $200 cheaper. So I'm going to go and do that. So there's switching happening within the market that's driving that volume up as well. So what the net new demand is in the market is a tougher thing to measure. We did make a calculation through our tracking of purpose-built absorptions, what the net change in occupied stock is. This would be within the buildings that have been completed since 2000 in the GTHA, so the relatively newer stock. And to your earlier point, we did see close to 5,000 of those units absorbed on a net basis. So it does show you that even though more supply is coming in, net absorptions are also rising. So, the population may be slowing down, but it's still increasing. We still have high levels of permanent immigration. Depending on where you live, there's net migration from other parts of the province or other parts of the country. Um, again, depending on where you are in the city, the international student enrollments and temporary foreign workers are still representing a pretty high percentage of the population. So there is some local differences there, but overall, we see that these demand-driven volumes have been rising. It's been interesting to see the dynamics also play out on a regional basis. So when you look at like downtown Toronto or the core of Toronto, central Toronto, it's experiencing much lesser rent declines than the rest of the GTHA. Now, part of that is because condo construction peaked much earlier than, say, the suburbs or the outer 416 area. So we haven't been delivering as many new condos into the core as we have in years past. But also, it's a migration of people back into the office that's helping to drive some of that demand too. And that's a bit more anecdotal, but in having conversations with agents that lease rental units out, it seems as though it's been a pretty big driver of absorption, particularly within the core. People don't want to commute; they're having to be in the office maybe 4 days, 5 days a week. So, they're looking to lease out a unit at least for now, and the absorption numbers on condos have been rising very quickly. I also think the purpose-built rental absorption has been rising because people have been, quite frankly, taking advantage of better affordability in the market. All of these incentives seem to be working, at least to a degree. 2 months of free rent, some cases 3 months of free rent, that could be enough to get a tenant into the door. So I think everyone's sort of adjusting to the new reality and trying to find where equilibrium is. But uh, you know, there's I think the thing we're learning through this adjustment is that there really isn't any shortage of demand at a certain rent level. If you price your units right, you're going to get somebody occupying that unit, and that comes through in the vacancy statistics, right? We measure vacancy, and it shows that yes, vacancy has risen, but 3.5, 4% depending on what area of the region you're looking at, but still considered to be a pretty balanced level. There's no oversupply necessarily of rental units in the marketplace. It's just rents got overinflated in 2022, 2023, and we needed an adjustment. And the catalyst for that adjustment was, more condos being completed in other parts of the country. It's been more purposeful rental units being completed. We've seen a orchestrated slowdown to the population. We have a softer economy. All of those things are helping to bring affordability kind of back to a better place. So yeah, no shortage of absorption for sure.
Yeah, and I think it's quite regional to your point, Sean. Like, uh, the CMHC report outlined that markets that have at least one university have experienced more softening in pricing. And obviously, that's an indication of potentially softer demand from the student market. And I'm sure, that's outsized to uh, where the student population is larger per capita percentage of the population. So we've definitely seen that. On the online side of things, one thing we track and that anybody can go on and track as well is just Google Trends. In fact, Google search in Canada has continued to trend up in Canada, just in general, for people using Google. So we know that uh, Google Trends, which is an online free tool you can use, is a decent barometer of how many people are going and performing online searches for rentals, and a decent barometer to demand in general. You can do all sorts of tests across the country. You can type in apartments for rent Halifax. You can type in apartments for rent Calgary, Toronto, and you can check and see what each trend line looks like in terms of the volume of those searches being done across, I think right back to the beginning of Google, but really the best data is in the sort of like the last 3 to 5 years. Nationally, we've seen sort of return back to what is sort of a normalized level of demand. There was that absolute spike and run up through COVID, where prices went wild, and then we hit such a point that the prices themselves actually softened demand because there was such an affordability crunch. The other thing you can do with that tool is you can filter by country. So you can, for example, filter down to searches being done for apartments in Toronto from India, as an example. And obviously, India has been the biggest source of immigration for Canada for a couple of years now. So we can see that that is significantly down, as an example, in the last year or two, since obviously we've had that deliberate policy change in lowering the amount of non-permanent residents and students as a result of that policy change. So it's a cool little tool that you can go and play around with and sort of check market to market what the demand trend looks like.
Yeah, one of the trends that we caught last year is that if you look at the breakdown of immigration data to Canada, you can see that the decline in the temporary resident population is driven almost entirely by study permit holders, whether they're study permit holders alone or a combination study and work permit. The vast majority of the reduction in the temporary resident population is associated with students. And so we did a small study on what was happening with demand trends and rent price trends in the areas around university campuses. And it is a pretty profound effect, especially when you look at areas like, Kitchener, which had a very high percentage of international students. And the effect is moderated if you're looking at a place like Calgary, which has a lower proportion of international students. So that is something that definitely has had a real noticeable effect on the market. So bridging over a bit to the condo side in the GTHA, one of the things that's been discussed a lot in the media and elsewhere is that we seem to be oversupplied with what they call micro condos, places that might be around 400 square feet or less. And something we've discussed on previous Rentsync podcasts is that it seems like over the past maybe 10 years, the built form of condos started being driven more by what investors were demanding than what end users were demanding. Do you think that's a real trend or an accurate observation? And if so, what do we do to prevent that sort of supply and demand mismatch in the future?
Yeah, I think the conversation around there being, you know, an oversupply of micro units is perhaps a bit sensationalized. I mean, when you look at the data, uh, like 5% of all resales on the market right now are under 500 square feet. Like it's not that much. Yes, they've experienced the softest market conditions. Like when you measure active listings against demand, probably have about 10 months of supply for the smaller units, and then maybe, you know, 5 or 6 months of supply for something of a mid-size range, and then market conditions kind of improve, the larger the unit you get because of supply and demand dynamics. Um, but they don't represent the majority of supply out there. Like, uh, it's certainly the case that we we swayed towards smaller units when the market was at its peak. When prices got very expensive, developers shifted more towards small units to kind of keep the end prices more manageable, and investors kind of focused and fixated on the end selling price rather than the price per square foot. And then you saw some interesting dynamics emerge where the price per square foot of a new condo actually started to grow like 40% higher than the price per square foot of a recently completed resale condo. And then, you started to look at those two metrics, you started to see some signals that the investment math no longer made a whole lot of sense. But certainly, one way they justified by continuing to build and continuing to buy units amongst investors was just kind of keeping that end selling price somewhat more manageable, and that involved really shrinking the units. So now what we're finding is that these units that were pre-sold to investors are starting to come up for occupancy, and the demand for them isn't obviously as strong as one would have hoped. Now, part of that is because the market has gotten more affordable. People don't necessarily have to live in 300 square feet. They can afford now a bit more space, and so they've graduated up the rental ladder, so to speak, to some larger units that they can now afford because prices have come down. Um, but it's true. If you look at some of these smaller units, the layouts on them aren't as livable as one would think, and that has really impacted their sale value and their rental value in the marketplace. So it was more of a commodity driven product that we're finding isn't as accepted amongst end users, and so the product is going to have to evolve, right? I think it's sort of lessons learned on this, that even though the market got less and less affordable, people don't necessarily want to cram into 300 or 400 square feet. Um, you know, uh, we're seeing that actually the best market conditions for both rental and resale is within 2 bedroom and 3 bedroom units. The problem is we don't build that many of those units, so you see some greater demand and supply frictions on that front. So as this has happened, we're going to see the industry evolve. It's sort of a natural progression that developers are going to have to move away from building as many of those small units. They still play a role in today's market. Don't get me wrong. Like, it's not as if our rental market in Toronto and Canada is cheap. We still need smaller units that provide an entry point into the marketplace for new immigrants and younger households that are establishing themselves. But maybe we just went too far in one direction. And as that is sort of playing out, we'll see that the product type that developers are building is going to become a bit more balanced. And that's already been happening within the purpose-built space. Purpose-built rental developers also kind of shifted a bit more towards smaller units, mostly because of affordability and to kind of maximize their rents per square foot in a difficult cost environment. But really where they're seeing the best return is on the 2 bedroom units, right? If you look at rental demand, most of the growth is happening amongst couples, and now you're seeing much more diversified demand from families, from downsizers, roommates. Like, it's not just young single person households that are coming into the marketplace. That's still part of the market, but we have to build for not just that segment. And if you look at vacancy and you look at rent performance, it's really those mid-size or larger size units that are doing better. So that'll help guide the market, I guess, through this next cycle. And we'll see a bit better of a balance between the smaller units and the mid-size units and the larger units. And the market will fundamentally change as we get through this cycle.
One thing that I think might also be an underrated factor here as it pertains to what some call like the dog crate condo is that many municipalities, including Toronto, sort of at the peak of what we might call the housing crisis, when demand was through the roof and pricing was 20% year over year, was that many municipalities moved to heavily restrict the use of short-term rentals and Airbnb. And it was a fallback of many of the investor units, which were, hey, look, if I can't sell my unit or I want to hold on to the unit longer, I can always Airbnb this unit, and typically via Airbnb, sort of increase your potential rent on an annual basis, doing short-term rentals. But since that has also kind of gone away for at least the city of Toronto, and I think Vancouver and a few other municipalities have moved to ultimately kind of do away with not non-principal rent residence Airbnb. I think that too will have an impact on the ability for investors to have sort of secondary purpose of of those smaller investor units. And I think that will be another driver to probably move away from so many of those types of units and into the larger. And then just anecdotally, from the work that we're doing with clients, we're certainly seeing clients paying attention to those changes in demand and seeing not a lot of new proposals for buildings that are more family friendly, have quite a few 3-bedroom layouts in comparison to years past, and especially 2-bedroom units, to Sean's point.
Yeah. Now, one of the things that you said in the Q4 condo market report is that this is the fourth consecutive year of decline in the market. And we've also been seeing that condo investors are deeply cash flow negative on new completions in many, many cases. So do you think that this price decline is just, a price correction from an overheated market, or are we starting to see more of a fundamental shift in behavior away from price speculation and towards, value-based investing based on capitalization rate or what amount of rent you can actually receive for a unit?
I can't stress enough how deep this downturn in the condo market has been. We've been a market within the GTA that has been pretty consistently selling 20 to 25,000 new condos every year for the last 20 years. In 2025, we had 1,600 new condos sell. It was the lowest volume of new condo sales since 1991. And just consider how much bigger the condo market is today versus what it was 35 years ago. This is by far the steepest downturn in the condo sector ever, in my opinion. And as you mentioned, we've gone through 4 years of decline. In that period, we've seen condo sales drop by 95%. We've seen resale prices drop by about 20%. New condo prices have been pretty sticky, mostly because of costs. We haven't seen a lot of adjustment towards where, let's say, market value is because developers are still dealing with high construction costs, municipal fees, development charges, those sort of things. We've seen some decrease, and in those cases, there's been, these projects been able to generate some sales, but it's an extremely difficult market right now. Um, it's not going to get that much better in the near term. I think we're still having to deal with supply issues, both from completions remaining elevated, even though they're expected to start trending down in 2026 into 2027. There's still a large number of those units that were pre-sold at market prices that are significantly higher than what market value is today. So there's still going to be quite a few challenges with issues related to closing. As you said, condo investors are in deeply negative cash flow. That's probably not going to change a whole lot in the near term, just given how expensive those units were when they were pre-sold. Um, and it's a sentiment issue too. Like there's not a lot of confidence in the condo market right now, and sometimes I feel like I take some of that blame because of all the headlines that our data puts out. And I go to presentations and talk about the condo market, and I can just see the looks on everyone's faces when I get up there to start talking about the state of the market. I feel like the bearer of bad news, and there's just not a lot of optimism right now about condos. But if you were to kind of look at it right now, it's a great buying opportunity in the cycle. Like as I mentioned, my condo prices have dropped 20-25%. Could they continue to fall? Yeah, probably. If you look at demand and supply indicators, the ratio of sales to listings and the amount of inventory in the market, there's probably a little bit further for prices to fall. But like how much further are they going to go? Like you can buy a condo today at prices that you haven't seen since like 2018, in some cases, maybe even 10 years ago. Um, you know, if you look at the supply trajectory in the coming years, it would suggest that there's upside for both condo prices and condo rents. So one thing we know, given this downturn in condo sales, is that there's not a lot of construction happening anymore. In fact, condo starts in 2025 have dropped 88% just in the past 3 years. And if you look towards the end of this decade, we're not going to be delivering any new condos at all. And that's not a forecast, that's a reality because we know how long it takes to sell a condo, build a condo, and deliver a condo. By 2029, 2030, the stock of condos in the GTA stops growing. There's zero supply. And also consider that's like two-thirds of all housing development that happens in the region coming from condos. Now, we've seen some pivot from condo to purpose-built rental, right? Some projects that canceled are going ahead as rental. Developers are switching tactics, and projects they were expecting to bring to market as condo are now starting construction as purpose-built rental. In fact, last year in the GTHA, we had nearly 10,000 purpose-built rental starts. It was the highest level since the 1970s. But it's nowhere near a level that is sufficient to offset the decrease in condo construction that's happening right now. So you get to a situation in a few years where, the population dynamics that we're sorting out right now with some changes in policy as it relates to non-permanent residents, I'm sure it'll stabilize and normalize within, 3 to 5 years. We get back to a situation where we're adding 100,000 people a year into the GTA. But guess what? There's no new condos being delivered. And yes, we're going to see some more purpose-built rentals, but there's still going to be a massive supply gap there. So I think the investor that's buying today that has at least a 5-year time horizon, is probably going to see some good upside. And as well, the developer who started construction on a rental project today and delivering into a stagnant supply environment in a few years is going to see maybe not an uplift in rents in the next year or two, but a pretty strong uplift, in year 3 or year 4 or year 5 when those units start to come into the marketplace. So it's a very interesting dynamic here where we're going through some cyclical changes, but structurally, we're still undersupplied, and that's going to remain the case, I think, in the coming years.
One of the topics I was going to get into is, we're seeing declining starts and rising cancellations. And, we may be overcorrecting a bit on that side. If you look at the government's projections and their targets, we're projected to return to population growth again in 2027. So we are going to see, more people coming in, and no real supply to absorb them. So, I mean, if we want to get ahead of that, we would have to do something to sort of moderate that disjoint between supply and demand. And one thing that we hear about persistently from developers is the cost of delivery issue, which is that basically at current sale prices, you cannot make money or even break even with how much it costs to construct a new unit. So, what do you think policymakers could do to sort of resolve that issue to ease the cost pressure on developers and make it viable to start building more units before we start seeing another severe supply crunch and just have it solved by, a price spike, which is going to reduce affordability for renters or people looking to buy?
Yeah, some of the adjustment on cost happens naturally through the cycle. Like with fewer projects under construction and fewer projects breaking ground, you start to see that construction costs begin to come down. Land prices are down like 50% from where they were at their market peak. So those costs have come down. But to your point, it's still difficult to make the numbers work, even with those costs lower than what they were because of how much stronger the price decrease has been. And like you can't sell a condo at replacement cost today. It's just a matter of math, and there's not demand out there for the cost at which it takes to build a new unit. So when you think about those other costs that could help move the pro forma into a more positive direction, obviously you have government fees that can take up 30% of the cost of a project. CMHC just put out a study on development charges for apartments. I think they did it across Canada. And unsurprisingly, they found that Toronto has the highest development charges in the country. It's like $130,000 per unit just in government fees. You had HST as well, which was obviously eliminated for first time buyers, but there's an argument to be made that that should be extended to all new home buyers, not just first time buyers. It's only one segment of the market. So there's a number of things that can be done. I think all of these things can work in tandem to help to bring new condo prices down to a level where demand can be kind of met, right? Because right now there's still a pretty big gap to which the price per square foot for a condo from developers is at, and where people are buying condos. And we did a bit of an analysis of this in our fourth quarter report, and it basically showed that if you looked at the small number of condos that are selling in today's marketplace, minus the luxury units that are over $2,000 a square foot, the people that are actually buying today are buying at like $900 a square foot. Now that's down a lot from a few years ago when people were buying at like $1,400 a square foot, but the asking price for condos is still like $1,200 a square foot, even though it's come down. So there's a gap there of like $300 a square foot that we need to bridge. Now some of it is correcting, as I said, through natural mechanisms on the cost side, but there's still a pretty big margin there that I think the government can step in and help out with. So it's one of those things where it's you rely on that source of funding for so long that it's hard to switch and tell developers we'll waive your development charges, and some municipalities have done that, but it's a tough thing to do because it's been in place for so long.
I think that's unbelievable that land costs have come down in certain markets as much as 50% from their peak. Construction costs will naturally come down, particularly labor costs, because if there's less demand, right? And yet it's still too difficult to make a project pencil. And I guess when you really strip it back and you look at it, development fees as a percentage of overall input costs into a project have skyrocketed. With other costs coming down, we're talking about development fees, which are mainly fixed fees, have absolutely skyrocketed. So if there's a place that governments can help out uh, and coordinate, it's on development fees. I mean, that's what's absolutely killing all housing development right now.
But I think that they also have a role in helping to stabilize the market to a degree. So we have two very identifiable problems, right? We have an undersupply of affordable housing, and we have an oversupply of condos right now, right? That no one can afford. So instead of trying to invest in building all this new affordable housing, which is a great thing, obviously we should invest in building affordable homes, but we have a lot of condos out there that developers would be happy to sell at a discount to the government that can make those affordable housing units and deliver them right away, right? We don't have to wait for 3 or 4 or 5 years for them to be delivered. So I think there could be a solution here to help stabilize the market and absorbing all of this excess supply by taking off a lot of development inventory from the hands of developers and putting that into the pool of affordable housing in the marketplace. There's uh there's a lot I think there that the government could be involved in here.
Instead of governments themselves building housing, which we know isn't always the most efficient efficient source of funds when it comes down to the per unit cost.
Yeah, I think to me, the development charges, if you look at the history of it, particularly in Toronto, it is really astonishing just how much they've gone up. And I think one of the issues that you have around that is that elected officials, policymakers, are very incentivized to sort of direct the burden of taxation towards things like development charges or land transfer taxes because voters don't see it on a bill every month or every year the way that they do with property taxes. And it's been said that profits hide a multitude of sins. So when home prices were increasing rapidly and everybody was making money hand over fist, you don't really notice the development charges and land transfer taxes and all these other, fees where people are accruing money out of the sales. You don't really feel that as much. But now that we're in this cost of delivery problem, it has a much larger effect.
But you just there's the old rule of thumb, which is you don't tax something that you want more of. Obviously, there needs to be some support and tax provided from the industry, and in particular, in order to offset infrastructure costs and whatnot. But like there's many people who have argued that housing in this country is now taxed at a higher degree than tobacco and alcohol. So when you think about that, that it's a Pagovian tax, which is that you want to tax things that you want less of, let's say tobacco and alcohol, and not tax things that you want more of. So, yeah, unfortunately, that's our reality. That's definitely an area where the government can step in and help out is just remove some of these barriers.
Okay, so we can wrap up here with a big picture question. Obviously, we're at an inflection point in the market right now. A lot of things are changing very rapidly. What do you think are some of the key considerations for both developers and property owners at this time?
Well, I think that one of the key considerations is that we are in a certain part of the market cycle that is not to their favor at the moment. Obviously, we have a temporary infusion of supply that's come from depending on where could be condos, could be purpose-built rentals, but we also know that the starts are telling us a different story. So the supply that we're seeing today is not necessarily the supply that we should be projecting into the future, nor should the trajectory for rents. And we do a lot of cost consulting, revenue consulting for new rental development projects. And, some of that involves some difficult conversations around the fact that the rents that were achievable a couple of years ago are unfortunately not achievable today. But you also have to consider that the trajectory for rents has also changed considerably. So while we've seen a temporary deflation in rents, a lot of that is going to be recouped on the back end of the next 5 years, right? As we transitioned pretty soon from a situation where we're delivering a record number of apartments to one where we're delivering pretty close to a record low for apartments. In the case of condos, basically no new apartments. You know for sure what's going to happen to rents. Like there's not a lot of magic behind this. If you look historically over time and view the relationship between rent inflation and the volume of completions in a given year, there's a direct negative result there, right? Higher completions, lower rents, lower completions, higher rents. Happens every single time. We know that the population is going to normalize. We hope that at some point the economy and economic uncertainty gets sorted out. And the situation will evolve in a manner in which rents will be materially higher in a few years than they are today. So I think you kind of have to look through some of the noise that's happening right now. If I'm a policymaker, like this is the exact wrong time to take your eye off the ball. Like some of them could be looking at this and saying, okay, prices are down, rents are down, affordability has improved, problem solved, right? We're delivering on our mandates. But it's sort of an illusion, right? Behind the fact that as this is happening, supply has been driven significantly lower, and we're actually going to end up in a worse off affordability situation in a few years if we don't act now. We basically have to triple the volume of purpose-built rentals that we're building in a market like Toronto right away in order to have any chance of reaching a balanced market in 5 to 10 years, like right away. And we're actually, every time I look at the data, every quarter, we're moving in the opposite direction. And that supply gap that we have to fill just keeps growing larger and larger and larger. So while it looks like things are getting better right now, you can be for sure certain that things are going to get worse in a few years, unfortunately.
Yeah, if you're under the assumption that population will continue to grow, and we're in a bit of a plateauing right now, but will pick back up, um, then it's hard to argue with anything Sean just mentioned, which is that rents will start to come back up. Um, the only thing I'll add is I think looking market by market, and even neighborhood by neighborhood is critical in analyzing, where demand is picking up, and where supply might be waning more, and also thinking about bringing differentiated product to market, in those pockets, in those opportunity zones, and uh, thinking about like what can I build unit wise, but also from the building amenity perspective that does differentiate my product. That's super critical in a more competitive market, which we're experiencing right now, and can be the difference between a major success from a lease up or a new condo build and a flop at the end of the day. And I think that's something that was not so necessary 6-7 years ago, when a lot of the supply that is now coming to market uh, was being thought through and being being built. But now more than ever, it's critical, because if you just come to market with the same old, you're gonna potentially get stuck in that undifferentiated product where it's just kind of price floor, almost like uh, StubHub or or a resale site from that perspective, where you just don't have a differentiated product, and so it's first to the lowest price at the end of the day. Uh, so yeah, that's really the only thing I'd add there.
All right. Well, that's it for this episode. Max, Shaun, thanks for joining us.
Great. Thank you.
Thanks for having us.